Okay, excellent. I think if we're good to go, we'll get started. Yes, as mentioned, my name is Matthew Ryan. So I'm Head of Market Strategy at eBri, where I've been based in our London office in Victoria for around about 9 years or so. I'm going to take about 15 minutes of your time today. The purpose of the presentation is to give a sort of general overview and our thoughts on the African currencies, what are the sort of main drivers of volatility and activity in Africa, and then give our sort of general thoughts as to where we think these currencies may be going. So let's start by looking at the sort of broader picture in the foreign exchange market. What's been the sort of main themes and drivers that we're seeing in the last couple of months or so? Clearly, the main sort of narrative in markets in the last sort of couple of months has been this broad rally that we've seen in the US dollar. The US dollar index has rallied by around about 7% since mid-July, to its highest level since November. Why has that been the case? Well, first of all, US economic data has been very good. The US economy is growing at a decent pace at around about 2% annualized, at a time when pretty much every other major economic area is slowing. We're seeing a deterioration in economic news in most other major areas, notably the likes of the Eurozone, which potentially could be on the brink of another recession. At the same time, the Federal Reserve has struck a very hawkish note. The FOMC indicated in its latest communications that it may raise rates on one more occasion this year, while every other major central bank has pretty much indicated that their tightening cycles are now over. So what has this done? Well, it's led to a strengthening in the US dollar against pretty much every other currency. It's also led to a sharp move higher in US Treasury yields, which have hit their highest level in 16 years, and that's provided further tailwinds for the greenback, as I said, against pretty much every currency in the last couple of months, including, of course, emerging markets and most of those currencies in Africa. How has the African currencies performed? Well, one of the main sort of, I would say, features of these African currencies is their dependence on their own idiosyncrasies. So we tend not to see a similar pattern in all those currencies, which means we have generally a pretty diverse FX performance in the region, which, as you can see, has indeed been the case in the past 12 months or so. Obviously, I've not covered all the currencies in Africa on here, but I have selected a few that we cover periodically in our forecasts. Of these major currencies, Ugandan shilling has held up the best and has actually managed to post modest gains against the dollar in the past year, which we attribute to intervention efforts from the Bank of Uganda, a pretty strong economic performance in the country, and notably recently, an easing in inflationary pressures. The inflation rate there is now back below 3%, which is particularly encouraging for the growth outlook. The South African rand has outperformed most of its African peers, although actually is underperformed other major emerging market currencies, notably the BRICS currencies. Only the Russian ruble has performed worse in the past 12 months. Ongoing energy crisis, of course, in South Africa continues to remain a big concern. This is expected to weigh on the country's economic performance. The central bank in South Africa expects this to shave as much as 2% of GDP this year. Around about the middle, we have the likes of the Ghanaian cedi, Kenyan shilling. The cedi has actually rebounded quite sharply from its lows in late 2022, as a deal was struck with the IMF of approximately $3 billion worth of funding. That has alleviated concerns surrounding Ghana's debt pile and has led to a rebound in the cedi and relative stability in the exchange rate in the last few months. Meanwhile, the Kenyan shilling continues to be gradually devalued by the country's central bank in order to ensure export competitiveness. Of course, at the other end of the scale, we have the likes of the Zambian kwacha. Concerns surrounding this mounting debt pile in Zambia has weighed quite heavily on the kwacha, while the Angolan kwanza, Nigerian naira, as you can see, both lost around about 50% of their value against the US dollar in the past 12 months, following massive currency devaluations in the summer. As far as the naira is concerned, there was a massive gap between the official and unofficial exchange rate, which proved unsustainable. While in Angola, we saw a big drop in foreign exchange reserves, which meant that the central bank there had very limited ammunition in order to intervene and protect the currency. One of the main idiosyncrasies that we talk about when we're covering Africa is the dependence of these currencies on macroeconomic fundamentals, disproportionately so relative to most other regions. When we say macroeconomic fundamentals, what do we mean? Well, we generally look at sort of 3 or 4 different pieces of data, those being FX reserves in terms of what months worth of import cover, current account balance as a percentage of GDP, external debt, again as a percentage of the economy, and then real interest rates, i.e. the nominal central bank rates minus levels of inflation. For the most part, we have seen a general improvement in levels of FX reserves in the last few months, albeit clearly these remain very low, too low for comfort, and much lower than what we see pretty much everywhere else. That what we generally tend to say 4 months worth of import cover for reserves is pretty much the bare minimum needed in order to intervene in the market and prevent currency depreciation. As you can see, we're sitting around about those levels for most of these countries, or slightly lower, which means that the central banks, authorities in those countries, have very limited room, limited ammunition to intervene in the market and protect the currency from a sell-off. External debt levels have improved for the most part in recent months, albeit there are clear exceptions, most notably in Angola and Zambia. The big concern here is, well, there's a few concerns. First of all, we have seen, of course, a big increase, aggressive increase in interest rates globally. We've seen a big spike in inflation. And for these currencies in particular, we've seen sharp currency depreciations. All of these factors push up the cost of servicing these debts, and it has been a huge concern for many of these countries, notably the likes of Ghana and Angola, which are currently facing some pretty serious debt problems. A big positive, though, that we think for these African currencies is the level of real interest rates. Real rates have turned positive in many instances, whereby the nominal central bank rate is now above levels of inflation. As you can see, like Angola, Zambia are boasting pretty firm positive real rates, which should be supportive of those currencies, as this provides a pretty attractive proposition to investors. As mentioned, levels of inflation have dropped in recent months in Africa, which is a very positive development for those countries' economies. As was pretty much the case everywhere, we did see this big jump in rates of inflation in Africa in 2022, or in some cases slightly earlier, following the reopening of economies post-COVID, and then, of course, following Russia's invasion of Ukraine, which has forced up commodity prices, particularly oil, of which these African economies are heavily dependent. But most central banks in the region have been pretty aggressive in tightening monetary policy, i.e. raising interest rates in order to bring down rates of inflation. The combination of rate hikes on the one hand and the base effect on the other means that these rates of inflation generally have dropped from their peaks. I've excluded a couple on this chart on the left-hand side where that's not been the case, in Nigeria and Ghana. But for the most part, we are seeing normalizations in rates of inflation. Real interest rates are turning positive. And inflation surprises have sort of normalized in the last few months. This chart on the right-hand side, this represents Citigroup's inflation surprise index. Any number above the level of 0 suggests that inflation data is coming in above expectations more often than not. Any number below suggests that it's missing expectations. As you can see, we saw a big spike in this data late 2021, 2022, but that has since normalized. Inflation data is largely coming in at lower levels, first of all, but also more in line with economists' expectations, which should be a positive development for these countries' economies. Another clear positive, of course, is the sharp increase that we've seen in commodity prices in the last few months or so. This chart on the left-hand side, this represents the CRB Commodity Price Index. This has risen, as you can see, quite sharply since around about June time, rising to its highest level in 15 months in September, amid supply disruptions on the one hand, and more optimism, growing optimism over the state of the global economy. We have seen a little bit of retracement in the last, couple of weeks or so in particular, led by a sharp drop in oil. Brent crude oil prices are now back to around $85 a barrel from a peak of above 95, amid renewed concerns over demand for commodities. Having said that, of course, though, we're still at pretty elevated levels. Oil prices in particular, as you can see, are still trading above 3-year and 5-year moving averages. The 5-year moving average stands at only around $71 a barrel, and even at $85, we're still well above those levels. So again, should be an encouraging development for these economies, and we think a bullish development for the economy's currencies. What's next for the African economies and the African currencies? We're expecting relatively solid growth on the whole in 2023, albeit the clear challenges to growth in the region means that these levels of expansion may be slightly lower than what we saw in the previous year. Clearly, there are a number of downside risks to growth in the region. First of all, global growth is pretty soft. As I mentioned at the beginning, we are seeing signs of deterioration in economic activity in the likes of the Eurozone. China, of course, is going through its economic problems of its own. Global growth in general looks set to be weaker amid still very high interest rates and high levels of inflation. That is likely to weigh on exports to Africa in 2023. High global interest rates and currency depreciation that we've seen in Africa also presents a downside risk, particularly its impact on debt in Africa. Higher rates, weaker currencies, high inflation, as I mentioned earlier, makes it more difficult for these countries to service their debt piles, which are relatively larger as a result of these factors. Extreme weather events also potentially providing an upside risk to inflation in Africa, given its impact on food inflation, which of course occurs or accounts for quite a significant proportion of the consumer price baskets in these African countries. And now, having said all that, there is of course reason for optimism, as there usually tends to be. We are seeing signs of these inflation rates falling in Africa, as I showed in the previous slide, and central banks in the region are beginning to start cutting rates in some instances. Lower inflation, lower rates should be good for domestic consumption and could potentially prop up growth. As I mentioned, commodity prices remain elevated, well above recent averages. Again, very bullish for the economies in the region. While we're continuing to see support from the likes of the IMF, the World Bank, that are dispersing funds to some of these countries, which should both alleviate concerns surrounding the debt levels in these countries, while also increasing levels of foreign exchange reserves. That should mean that these central banks have more room to intervene in the markets, more room to protect their currencies. So what is our general view on the currencies in Africa? Well, as I mentioned, we hold a moderately optimistic stance, I would say, on these African currencies. There's we think, three main pillars behind this call. First of all, as I mentioned, macroeconomic fundamentals in the region have improved in recent months. Notably is this increase we're seeing in current account balances, which in many cases are now firmly positive, while real interest rates have also turned positive following drops in inflation, which again should be encouraging developments for these currencies. The sell-offs that we've also seen in recent months and in recent years have left many of the currencies undervalued in real effective exchange rate terms, i.e. once inflation is taken into account. That tends to lead to potentially rebounds and snapbacks in these currencies from these rather undervalued levels. Lastly, as we mentioned, commodity prices still remain relatively elevated. We have seen a recent retracement, but we're still above recent moving averages. Again, optimistic and an encouraging sign for these economies, and we think should provide some support for the currencies. So in most cases, we are either penciling in modest rebounds in these currencies from very low levels, or sell-offs that are no greater than inflation differentials with the US. That's everything from me in terms of content. Just a quick note that we do have a stand on this floor, I believe, in the far corner. So if you have any questions, any thoughts, if you'd like to talk to the team at all, please feel free to drop by, and someone will be pleased to speak with you. Thank you, everyone.